How to get rich off stocks. 10 steps to begin now. It often seems as if everyone is looking for the secret sauce to get rich off stocks and many other investments as well. In truth, there really are no secrets. There's nothing magic about investing in stocks, and no guarantees you'll ever get rich, but there are strategies you can use with the potential to greatly increase your wealth in the coming years, and we will tell you all about it in this video. Is it possible to get rich with stocks? In theory, yes. In reality, well, let's just say it requires a lot of work and commitment. If it were otherwise, and especially if it were easy, everyone would be rich. Below are our 10 steps to start your journey to stock market riches. And even if you never get rich, it's very likely that in a few years you'll be in a much better financial position than you're in now. Number 1, stay on track. Become a long-term investor. Like most other money-making strategies, stocks are a process of getting rich slowly rather than getting rich quickly. Most people would agree that $603,000 is much closer to getting rich than $11,000. This means that you should start contributing to your investment program now, with the expectation that it'll essentially become a lifestyle. This means that you need to invest over decades, not just months or years, but with the right mindset. Number 2, set a schedule for your contributions and stick to it. This is one of the most difficult steps for most new investors. The cost of living is high and rising every year. Finding extra money in your budget to invest can seem like an impossible task, but it's not, as long as you set your goals low enough. Low enough? That's right. You don't have to try to take the investment universe by storm by investing a lot of money up front. You can also open an investment account with no money at all, and then start investing little by little. Again, start small. Even if it seems like a small amount, you can start to build momentum. When we first started investing, we could only afford $25 a month, which we used to buy a mutual fund with average performance. It wasn't much, but it was something. Number 3, invest with index funds. Index funds are the best ways to invest for most people. They allow you to invest in an entire market or in different market sectors. For example, you can invest in a general market fund based on the S&P 500 index. For the price of a single share of an S&P 500 index fund, you get a share of the approximately 500 largest publicly traded companies in America. Alternatively, you can invest in individual market sectors. Examples include energy, utilities, technology, biotechnology, and healthcare, among many others. You can also invest in index funds that specialize in foreign markets such as Europe or Japan, or emerging markets in Latin America and Asia. You can even choose index funds that focus on a specific performance, such as growth stocks or high dividend stocks. Index funds are designed to track the underlying index to which they're linked. This means they're considered passive investments because they don't actively trade stocks within the fund. Stocks only trade when there are changes in the companies listed in the corresponding index. Number 4, invest through tax-deferred retirement accounts. One of the best ways to invest in stocks is through a tax-deferred retirement account. This includes an IRA, Roth or traditional, or an employer-sponsored plan, such as a 401k or a 403b. Retirement accounts are great for stocks because not only are they a perfect way to invest for the long term, but they also offer numerous tax advantages. For example, contributions to traditional IRAs, but not Roth IRAs, and most employer-sponsored retirement plans are generally tax deductible, so you can reduce your tax liability each year you make contributions. The tax deduction you receive for your contributions means that at least a portion of your investment contributions will be covered by the tax savings. If you're serious about investing in the stock market, and more importantly, getting rich, investing through a tax-sheltered retirement plan is one of the best strategies. Number 5, diversify your stock portfolio. Diversification is one way to reduce volatility in your stock portfolio, which ironically can also improve long-term returns. There are several ways to diversify your portfolio. The first is to diversify between stocks and stock sectors. When you invest in index funds, you're already diversifying among stocks. That's because index funds can hold stocks from dozens to hundreds of individual companies. In terms of stock sectors, you can invest some of your money in an S&P 500 index fund while holding positions in an international fund for global exposure. You can also invest in specific industry sectors that you believe will outperform the general market. The investment industry offers you a lot of choice in this regard. The second form of diversification is to invest some of your money outside of stocks. This means that in addition to stocks, you should also hold positions in cash and bonds. Cash and bonds serve to minimize losses during a downturn in the stock market and provide you with the capital you need to invest more money when the market begins to recover. Number 6, be prepared to shift gears when needed. We've just discussed the common formulas for determining portfolio allocation between stocks, bonds, and cash. However, these are just guidelines that you might even consider as a starting point. Choose one over the other and make adjustments as needed. For example, if you have a more conservative risk tolerance, you may want to start with 100 minus your age and then reduce the equity portion even further until you feel comfortable. You should also be prepared to adjust your portfolio as your circumstances change. Number 7, increase your contributions over time. In step 2, we covered setting a contribution schedule. This will certainly get you going in the right direction, but don't stop there. The sooner you start investing, the better your bottom line will be. And the more you can invest, the faster you'll reach your goal. Increasing your contributions doesn't have to be a dramatic process either. You can gradually increase your contribution over several years. Your 5% in the first year becomes 6% in the second year, then 7% in the third year, and so on. After 5 years, your contributions will be 10% of your salary. After 10 years, the contribution will increase to 15%. To minimize the impact of the annual increase, you can match the increase with your annual salary increase. So, if your company increases your salary by 3%, you can use 1% of that to increase investment contributions. Number 8. Get advice on investing in stocks. If you know little about investing and don't have time to acquire the knowledge you need, you have several options. The first is to invest through an automated online investment service, commonly called a robo-advisor. They're easy and inexpensive to use. You can open an account online, fill out a questionnaire that helps the advisor, determine your investment portfolio, and gradually fund your account. Number 9. Don't get greedy. Sometimes it's said that fear and greed are the two emotions that drive the stock market. And that's not so far from the truth. As a retail investor, you need to be wary of both. The same goes for day trading and virtually any type of investment activity beyond what you're comfortable with. Be careful here because there are many proponents who claim that these high-risk activities are highly profitable and within reach of average investors, but in reality, they aren't. Number 10, start investing now. Right where you are. This is the last step, but it might as well have been the first. If you're serious about becoming a successful stock investor, you need to get time on your side. And since you didn't have that yesterday, 5 years ago, or 10 years ago, now is the best time to start. And as we discussed earlier, you can open an investment account with no money down and gradually start investing as you fund your account. You can either start with a few dollars or gradually make contributions to your plan from payroll. The point is that you'll get more money with fewer contributions if you start right now, right where you are, than if you wait until later when you've gotten your financial life in order. As is the case with all things great and wonderful in life, there's absolutely no guarantee you'll get rich off stocks. But the long-term averages are in your favor if you do invest, and you'll have a much better chance of at least being in a better financial position in the future than you are right now. And please, tell us what you think about it down in the comment section. Also, don't forget to like and subscribe to the channel for more videos like this.